Evergrande is a Chinese real estate company which belongs to the Global 500, meaning that it is one of the world's biggest businesses by revenue. The truth of the matter is that Evergrande expanded mainly through debt, through loans, and these are massive loans. Evergrande owns 1,300 projects in 280 cities in China. It has a services management unit which is involved in 2,800 projects across China. In 2020, Evergrande ran short of liquidity and since then had been on a downward spiral, be it on operations, stock market, and sales of units. The company was able to finance its growth prospects and projects through borrowings, through financing. Evergrande was known as China's most indebted developer to the tune of $300 billion. In recent years, Evergrande's debts ballooned as it borrowed to finance its various pursuits. The Evergrande crisis started to surface when the company experienced troubles finding buyers for its assets. Therefore, just like any other company, revenue being a major part of income, no buyer means no revenue. The problem with Evergrande is that it is so indebted that it cannot afford not to sell as much as it could. It needed liquidity to pay its debt. To add to this dilemma, the Chinese government, in its pursuit to promote common prosperity, had started to crack down on corporate debt and monopoly. As a result, Evergrande could no longer borrow money, which then led to its credit payment default. And this is exactly the reason that I have been preaching on my videos about debt. Debt means death to a company. Let me show you what Warren Buffett have to say about debt.
Whenever a bright person, really bright person goes broke that has a lot of money, it's because of leverage. You basically can't, it'd be almost impossible to go broke without borrowed money being in the equation. And as you know, at Berkshire, we've never used any real amount of borrowed money. Now, if we used somewhat more, we'd be really rich. But if we'd used a whole lot more, we might have gotten in trouble sometimes. And there's no upside to it. What's 2 percentage points more, in a given year or that year, and run the risk of real failure. But very bright people do it, and they do it consistently, and they will continue to do it. And as long as explosive type instruments are out there, they will gravitate toward them, and particularly people will gravitate toward them who have very little to lose but are operating with other people's money. One of the things, for example, in the LTCM case, and Charlie mentioned in terms of derivatives, in effect, there were ways found to get around and they were legal, obviously, to get around the margin requirements, because risk arbitrage is a business that Charlie and I have been in for.
No matter how much growth in revenue a company has year over year, no matter how grand the future plans of the company are, no matter how many people tell you how great of an investment a certain company is, if this company is indebted to the bones, you must say goodbye. You have to move on and look for another company. If I only had $5,000 to invest, there is no way on earth I would invest this money in a company that has more than 3 years of its earnings equivalent to its debt. I have seen many YouTube videos wherein people recommend investing on TELUS. Yes, looking at this table, TELUS's revenue had been increasing, but look at their debt. Their debt increased much faster than their revenue. Their debt is equivalent to more than 10 years of the company's earnings. Look at the current assets and current liabilities of this company. The liabilities were bigger and higher than the assets of the company year on year on year. And despite this dire debt condition, the company management increased their dividend payments instead. As a matter of fact, they have increased the dividend payments year on year on year. This is what you call a dividend trap. Another popular Canadian company that is publicly traded is TD Bank, or Toronto Dominion Bank. There are good numbers that represent TD Bank. For one, their book value is high, at almost $55 a share, whereas it is currently trading at $86 a share. The company's revenue is increasing as well, but looking at the debt of this company runs shiver down my spine. The current debt versus current assets was almost 1-to-1 ratio since 2014, but that changed dramatically in 2020 where their debt ballooned to over $1 trillion. TD Bank's debt is equivalent to more than 10 years of the company's earnings if the market crashes tomorrow and TD's debt payment contract comes into full force. What shall become of TD? Will it borrow to pay borrowings? Will it ask liquidity from the government just like Air Canada? Or worse, would it default? I do not know what will happen. I do not have a crystal ball to predict the future. What I know though is that I refuse to think what will happen to TD shall it experience financial hardship. And that is the very reason that I am not invested on TD Bank. Even if a company has great revenue and great plans for the future, if the debt penetrates to the bone, I move on. I only have so much money I can invest, and I intend to invest it in a stable company that I believe in. Another company that I believe is worth mentioning as well is a company called Enbridge. Enbridge owns extensive midstream assets that transport hydrocarbons across the US and Canada. Enbridge is Canada's largest natural gas distribution company. Looking at the table here, Enbridge have recorded acceptable revenue, somewhat choppy, but nevertheless acceptable. The company's profitability has been recorded to increase from 2016 to 2020. The ROE and ROIC were all single digits, which I consider as lower than average, but nevertheless, the company is profitable. The company has a good book value per share as well in the trailing 12 months, sitting at $30.62 a share, whereas it is currently trading at $52 a share. But now we have to look at the company's debt. If you look in 2016, Enbridge current liabilities was almost 2 times bigger than its current assets. And that situation was not only in 2016. It was the same in 2017, 2018, 2019, 2020, and the trailing 12 months as well. And this is not a good thing. At least for me, it is not. And to cap it all, Enbridge's total long-term debt is equivalent to more than 10 years of its earnings. Even if Enbridge is the largest natural gas distribution company in Canada, even if the company's revenue is growing, and even if the company has great future plans, to me, I will not risk my money on a company that is indebted equivalent to more than 3 years of its earnings. So then I move on. Again, everyone, this is a personal preference. With all the books that I have read, trainings that I have attended, investment programs that I have completed, and certainly through my own personal experience on investing. Debt kills, and debt is a factor that I look for and consider extremely seriously in any company. Just because a company earns and has a lot of money does not mean it cannot go broke. After all, the world's greatest investor have said it all. And I quote, "Whenever a person who has a lot of money goes broke, it is because of leverage. It is impossible to go broke without leverage."
Thank you very much indeed. I hope that you enjoyed this video, and I hope that you gained value from my video and my channel as a whole. If you did, please share, like, and subscribe, and I certainly hope to see you on my next video.